Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Hello everyone, welcome back to the channel. In today's video, we are talking about how to spot and avoid risky shadow banking fintechs. If you want to protect your money from high-risk financial platforms and learn the warning signs of unsafe fintech companies, then this video is for you. Let's get started. The rise of financial technology has changed how we move, save, and grow our money. We no longer need to visit a physical building to get a loan or open a high-yield savings account. However, this convenience comes with a hidden catch that many investors overlook. Some of these companies operate as shadow banks, which means they provide bank-like services without following the same strict rules as traditional institutions. They often look and feel like a standard bank, yet they lack the safety nets that protect your capital. Because these firms sit outside the traditional regulatory umbrella, they can take much bigger risks with your cash. If you aren't careful, you might put your money into a company that could vanish overnight. This guide will help you spot the red flags so you can keep your portfolio safe from these unstable players. Warning signs of risky fintech firms to avoid. Investing in a new financial platform feels exciting, especially when the returns look better than what your local credit union offers. But you should always ask why those returns are so high. Dangerous fintech companies often lure people in with promises that seem too good to be true. For example, if a firm offers double the market rate for a simple savings product, they are likely taking massive gambles behind the scenes. They might be lending your money to high-risk borrowers or using it for speculative trading. Transparency is the most important factor when you evaluate these companies. A healthy firm will tell you exactly how they make money and where they store your deposits. In contrast, risky shadow banks often use vague language to hide their business model. They might claim to use proprietary algorithms or secret strategies to generate wealth. If you cannot understand the basic mechanics of how a company earns its profit, you should stay away. In addition, watch out for firms that focus more on flashy marketing than on their balance sheets. A sleek app interface does not mean your money is safe. Many failed startups had the best designs in the industry right before they went bankrupt. Companies with no clear regulatory oversight. One of the biggest dangers in the fintech world is the lack of a banking license. Real banks must follow strict capital requirements and submit to regular audits by government agencies. However, many fintechs operate in a gray area where they aren't technically banks. They might be based in offshore jurisdictions with very weak financial laws. If a company does not have FDIC insurance or an equivalent government guarantee, your money is at a much higher risk. Without this protection, you are just a general creditor if the firm goes bust. This means you might only get back pennies on the dollar after a long legal battle. Always check the fine print at the bottom of their website. If you don't see a clear mention of a regulated partner bank or direct government oversight, you're looking at a shadow bank. These entities can move money around with very little accountability. As a result, they are far more likely to fail during a market downturn. That's it for part 1. Now you know the warning signs of risky fintech companies and why transparency and regulation matter. In part 2, we will talk about how to protect your portfolio from fintech failures and how to stay financially safe in the digital world. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.